Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. COVID-0 concerns. Stocks drop, treasuries and the dollar gain as Beijing tightens curbs amid a resurgence of the virus, including the first fatalities since May. Seeking the old magic, Bob Iger makes a surprise return as Disney chief executive amid a string of disappointing results and a slumping share price. And historic agreement, negotiators at COP27 reach an 11th hour deal for a fund that compensates developing nations for climate devastation but falls short on fossil fuels. We're live in Sharm el-Sheikh. Now, good morning. First of all, let's check on the markets. All, of course, about what the Fed does, but also China concerns after we see that China may tighten COVID curbs after a string of reported deaths. This is also having an impact on European stocks, down 0.2%. The U.S. 10-year yield, we did see this move into risk havens such as treasuries, but also such as dollar. The U.S. 10-year yield at 3.8119, and then sterling 1.1820. Now, the one story we also need to keep an eye on is Disney. It came as a surprise to a lot of people that they decided to bring back the chief executive that left 2 years ago. Just on the back of that, we don't have any announcement of what he'll do to put Disney back in shape, but actually the stock price in German trading is up 10%. Now, the picture overall for Europe, and there are a lot of country-by-country concerns, or certainly stories that are different from one another. Now, the IBEX over in Spain is gaining 0.3%. Here in the UK, the Prime Minister will also be in Birmingham addressing the CBI. Our Lizzie Burden is there on the ground for us. There was quite a lot of debate on whether they were looking for a Swiss-style agreement. The Brexiteers came up in arms over the weekend. CAC 40 down to some 0.3%, and then the DAX down 0.5%. Now let's get straight to the Bloomberg First Word News with Alice Atkins. Hi, Alice.
Hi, Francine. Malaysia's political leaders now have until 2 p.m. Tuesday local time to decide on a prime minister. The king has extended the deadline by 24 hours after Saturday's vote resulted in the country's first ever hung parliament. Opposition leader Anwar Ibrahim says he has the numbers to form a government despite falling short of a simple majority. The COP talks in Egypt have ended with an agreement to help developing nations face the devastation of climate change. Although the deal for a loss and damage fund paid for by rich countries is seen as a breakthrough, negotiators failed to agree further cuts in CO2 emissions. The UK government says it isn't seeking a new Swiss-style relationship with the EU. The pushback comes after a Sunday Times report that Prime Minister Rishi Sunak's administration is exploring closer economic ties with its European neighbours. Switzerland is a member of the European Free Trade Association and participates in the single market for most goods. The UN's Atomic Agency says powerful blasts have shaken the area around Ukraine's Zaporizhzhia nuclear power plant. The IAEA says some buildings and systems were damaged, but none critically. Ukraine's nuclear regulator says Russian forces struck the facility. Moscow blames Ukraine for the shelling. Global news, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Alice, thanks so much. Alice Atkins here in London. Now, China may tighten COVID curbs after a string of reported deaths, which has led to declines in Asian stocks and a bid for haven assets. We're now joined by Trevor Greetham, head of multi-assets at Royal London Asset Management. Trevor, thank you for joining us. I mean, the market's definitely concerned about what's happening in China after we were expecting COVID-0 to be relaxed a little bit. What kind of China does the world economy and world markets need?
It's a really good question, and I think it's maybe a bit counterintuitive, but we're still in this kind of topsy-turvy world where good news is bad news because the markets are still really sensitive to interest rates and where the peak in Fed funds would be. And in our team, certainly, we're talking about a possible reopening of China next year as something that could keep inflation high, keep interest rates rising, and therefore being bad for stocks. So it's a bit of a strange one, actually, that it's bad for earnings if China is shut down, but it's actually good in terms of the peak of interest rates.
Yeah, so it is all about what the Fed does, and of course where we see, peak inflation and interest. Where do you expect, the terminal rate to be for the U.S.?
Oh, it's really hard to say. I mean,
how often do you get asked that? Hourly?
Well, I think it's one of those things where you look for the signs of what will cause the Fed to pause, and in my view, they'll either pause because unemployment has started clearly rising. And you know what unemployment does? It gradually moves lower during an expansion, and you're waiting for that moment when it cracks. But when it cracks, it cracks. You know it when you see it. So we're waiting for that moment when the Fed is likely to pivot because of either rising unemployment or maybe there'll be a credit event that will cause them to step back. But we don't see either of those things yet.
And so that means that what we're going to see, I mean, have we reached peak inflation? And when we've reached it, how do you know? Is it just literally month-by-month data that keeps on going down? Or is there a measure that you look for to preempt?
Well, there are measures that can preempt. So inflation's more than one thing. And there's like a leading edge of inflation, if you like, that's already falling. So some commodity prices, if you look at surveys of things like supply chains, they're very much opening up. So there is lots of slack in supply chains now, so less focus on China and what it might do to supply chains. But core inflation measures like wage inflation, service inflation, shelter, they can take a year to peak after the headline measures peak. So we're at that early edge now where it feels like the markets will be talking about falling inflation next year and headline measures should be falling. But that doesn't mean to say the Fed will immediately cut rates.
Can we avoid a recession in the U.S. and overall, where's the leverage? Is this the biggest question that you need to try and answer? As interest rates go up and they're going up quite rapidly, are there parts of the markets that you worry about funding?
Yes. So can you avoid a recession in the U.S.? Possibly. So I've heard the argument that inflation will fall so dramatically that real incomes will expand and there'll be no need for a recession. I'm really skeptical about it because if you look at things like housing, so you go back to the interest rate sensitive bits of the economy, housing looks like it did in the mid-2000s. It's looking horrible. This is a Fed-induced recession. So I think it's very hard to avoid the recession.
Right. So where do you put your money?
Well, at the moment, we are beginning to like government bonds. So beginning of last year, we were maximum underweight, this year I should say, maximum underweight government bonds. But the way we look at next year, it should be a slowdown, but this time with headline inflation measures dropping. And I think the long end of bond markets is starting to look interesting.
Okay, interesting. Trevor, thank you so much. Trevor Greetham, head of multi-asset at Royal London Asset Management, stays with us. We'll talk a little bit more about bonds, but we'll also talk about some of the corporates out there. Coming up, Disney soars as a media giant brings back former leader Bob Iger as chief executive. Well, we'll have all of the details next, and this is Bloomberg. Economic, finance, politics. This is Bloomberg Surveillance, early edition of Francine Lacqua here in London. Now, Disney has soared in pre-market trade after welcoming back the former chief executive, Bob Iger, to his old job, effective immediately. Well, Iger stepped down as chief executive in 2020 after leading the company through a period of enormous growth over 15 years. Well, he remained on the board of directors for another year. Joining us now is Alex Webb of Bloomberg Quick Take, and Trevor Greetham, head of multi-asset at Royal London Asset Management, is still with us. Trevor, we'll talk about corporates and some of the changes in general, what kind of leader you're looking for in companies. But this is incredible. I mean, this is an incredible story. So Bob Iger's back. The Magic Kingdom hasn't been so magic in terms of returns in the last couple of years. No,
and astonishingly, Bob Chapek was awarded a new contract just over the summer. So the change here has been rapid. The thing that had happened with Disney is that activist investors had looked at the share price of Netflix, and particularly the price to earnings ratio. It was trading at something like 50 times forward earnings. Disney was trading around the 20s, and they said, well, we'll have a piece of that, thank you very much. You should be more like Netflix. Therefore, Disney pivoted, investing significantly in the streaming platform, Disney+. It then got pretty close to Netflix as a price to forward earnings ratio, I should say. Then, of course, we saw the fallout of the pandemic conditions easing, and Netflix, its user numbers stagnated, its share price fell, Disney followed it.
I mean, I just find it incredible. So the share price in Germany at the moment in pre-market trading today is up 10%. I mean, they still have an activist investor on their back. Was it because the chief executive was shockingly bad, or is it really because Bob Iger can turn this around once again?
A lot of the commentary we've seen is that actually the messaging is kind of what's important. That it's not necessarily there will be significantly changes in the strategy. The one thing that Bob Chapek had not been terribly good at communicating was actually how this capital that is being spent right now on content for the streaming platform might ultimately yield dividends. And you pair that with the impact internally on the culture, where Bob Chapek had made some decisions that weren't terribly popular, trying to move staff to Florida, political things that he maybe hadn't been as outspoken on as Iger had, tentative support seemingly for Republicans, as has been reported, because there was an expectation that they would do very well at the midterms. That has maybe backfired, as we can see. So there's lots of moving pieces here. Ultimately, Bob Iger, steady pair of hands. It's only a 2-year contract. We'll have to see who else comes in.
So, Trevor, I mean, you don't want to talk specifically about Disney, but does this show the difficulty of media companies? I mean, these are, again, they have parks, they have now to make TV shows catering for a streaming service, which is what they bet on, or is this just a, stamp kind of bad chief executive being replaced? Well,
I think stepping back a little bit, there's a general message in the markets for growth companies, so be they media, be they technology, where rising bond yields has seen multiples collapse in the stock market. And as a macro person looking at that, it's been very interesting to see how people immediately point the finger and say every chief executive of a growth company must be terrible. Their most recent decision must have caused the stock price to drop in 2022. That's not the message the markets are giving at all, actually. They're just derating the growth stocks because interest rates have changed. That said, in this environment, as a CEO, you do need to make sure you're not over-investing in things which will be very economically sensitive in the recession. So the message to sort of scale back a little bit, which some of these companies have taken, isn't because their last move was stupid, it's because the cost of money has changed. Yeah, and one of the things they say, I mean, for Iger specifically, is that he is, for example, very popular with the rank and file workers. How do you choose what industries you want to be invested in right now? Well, I think it's a question as a top-down investor of that interest rate sensitivity, where that's starting to become more interesting, and earnings resilience. And so if you can imagine that we're getting more interested in government bonds, that means there'll be sort of stable growth companies that could actually do very well, and the consumer staples, or some of the technology and media companies with more reliable earnings. I always enjoy your Twitter feed, and sometimes Trevor also, gives it back to Elon Musk, or certainly you weigh in on some of the big. Well, I'm not the only one. No, you're not the only one. I mean, it's like a national obsession. Like, why are we so obsessed with what's happening to Twitter? I mean, it makes for great copy. A lot of it, it's so many moving parts. There's great, huge personalities, not least Elon, but some of the other people involved. It is a fascinating story. The thing I've long been trying to point out, Twitter is not a big company in the grand scheme of things. It has an outsized influence in terms of politics, particularly given who its audience largely is. But the data point I often point to, Twitter's revenue is less than BT's profit. It is not a large company. It is not a big tech company, but it is very influential in Silicon Valley. Yeah, and I know you also cover FTX, and this, 50 creditors are owed something like $3 billion. What does that tell you about the space? I'm one of these sort of skeptics that sort of back in 2017, I was sort of saying, I was being asked a lot, as an asset allocator, why don't you have an allocation to crypto generally? And my view was there's no long-term track record, you don't understand its economic sensitivity, and it's very prone to fraud. And I think that's what we're starting to see here. So I think it does cast a bit of a pall over the space. All right, thank you both for joining us. Alex Webb, there of Bloomberg Quick Take, and Trevor Greetham. Also give him a follow on Twitter, head of multi-assets at Royal London Asset Management. Coming up, we're live at the CBI conference, where the Prime Minister is set to address the UK's biggest business group. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Alice Atkins. Hi, Alice.
Hi, Francine. New court papers show Sam Bankman-Fried's bankrupt crypto empire owes its 50 biggest unsecured creditors a total of $3.1 billion. According to the redacted list, entities linked to FTX owe their single biggest creditor more than $220 million. Investors continue to pull funds from digital asset exchanges despite efforts to reassure markets about their stability. Walt Disney is bringing back former CEO Bob Iger to run the company. The 71-year-old spent more than 4 decades at Disney, including 15 years as chief executive. The company says he's agreed to serve for 2 years, succeeding Bob Chapek, who is leaving immediately. Disney shares are heading towards their worst annual loss since at least the 1970s. Sweden's home prices decline accelerated in October, with values now 14% down from their peak earlier this year, according to data from ValueGuard. It's the most severe housing slump in 3 decades, fueled by soaring inflation and central bank moves to curb price increases. The IMF says the rise of trade barriers against China and other countries over the past year could cost the global economy $1.4 trillion. Fund Manager Director Kristalina Georgieva says the potential loss for Asia could be more than 3% of GDP because the region is more integrated into the global value chain. The COP talks in Egypt have ended with an agreement to help developing nations face the devastation of climate change. Although the deal for a loss and damage fund paid for by rich countries is seen as a breakthrough, negotiators failed to agree further cuts in CO2 emissions. And the UK government says it isn't seeking a new Swiss-style relationship with the EU. The pushback comes after a Sunday Times report that Prime Minister Rishi Sunak's administration is exploring closer economic ties with its European neighbours. Switzerland is a member of the European Free Trade Association and participates in the single market for most goods. The UN's Atomic Agency says powerful blasts have shaken the area around Ukraine's Zaporizhzhia nuclear power plant. The IAEA says some buildings and systems were damaged, but none critically. Ukraine's nuclear regulator says Russian forces struck the facility. Moscow blames Ukraine for the shelling. That's your Bloomberg Business Flash. Francine?
Thank you so much, Alice Atkins. In London, now the former Treasury Secretary Lawrence Summers has a warning for U.S. policymakers. Focus on building your own economic strengths in the contest with China rather than attacking them. Here's more from his conversation with Bloomberg TV.
I think it's a mistake to be slavish about Taylor rules. The market thinks the number's going to be about 5. I look at things and my sense is there's more room for that to be too low than there is for that to be too high. But it's pretty clear that we've had the big moves on this cycle, and now we're going to be finishing that process off. But I think that the Fed has this in the right place when it says that they're going to move up somewhat more, and they're going to take stock of the situation and see what the inflation data is saying and seeing what the inflation forecasts are saying when we get to the spring of next winter of next year. I have to say that if they hadn't made as many mistakes as they did of excessive optimism about inflation, they'd probably have a little more room than they do to rely on forecasts that hadn't yet proved out that inflation was going to come down.
Larry, you and I talk a lot about monetary policy, even fiscal stimulus and things, but geopolitics have also factored increasingly in some of the issues having to do with the economy. This week we had what is potentially, we don't know if it is, an important development in the meeting of President Xi of China and President Biden. What do you make of those discussions and even ongoing discussions? Because now we have the USTR, Madam Tai, actually meeting with her counterpart. What do you make of the situation with China right now in the United States?
Look, as Churchill famously said, jaw, jaw is a lot better than bang, bang. And so the fact that they had a meaningful conversation that lasted more than 3 hours, the fact that they both came out of the conversation with a sense that there had been satisfying dialogue, the sense that there are some follow-on steps, I think that's all to the good. What it's really going to mean, what really is going to happen, is there going to be constructive movement out of those dialogues? I think that's something we're going to have to wait and see. We in the United States probably need to be careful about our evangelizing influence. I don't think it's really for us to tell China how they should organize their entire society. I think it's for us to stand up for some of our fundamental interests in security and fair economic competition, but to leave it at that point. I think we're going to need to be very careful with respect to our diplomacy.
Well, that was the former U.S. Treasury Secretary Larry Summers speaking on the U.S. and China to Bloomberg TV. Now, coming up, we'll get back to the markets with Kim Fournais. He's Saxo Bank Chief Executive Officer and founder. In the meantime, a lot going on in the markets. The focus firmly on what's happening in China, but also we're seeing some euro-dollar moves, for example. Now, stocks are dropping. They started by dropping in Asia. They're still dropping in Europe. There's concern that China may actually tighten its COVID curves. This is after a series of reported deaths. The other story we're watching out for is Disney. Now, pre-market, it's now open and it gained some 10% after a replacement of the chief executive. They brought Bob Iger back. The dollar also climbing against G10 counterparts and emerging market currencies. Treasury is giving back earlier gains. Oil down on concern of a weakening demand outlook from China. We'll have plenty more on the markets. This is Bloomberg. COVID-0 concerns. Stocks drop, treasuries and the dollar gain as Beijing tightens curbs amid a resurgence of the virus, including the first fatalities since May. Seeking the old magic, Bob Iger makes a surprise return as Disney chief executive amid a string of disappointing results and a slumping share price. And historic agreement, negotiators at COP27 reach an 11th-hour deal for a fund that compensates developing nations for climate devastation, but falls short on fossil fuels. We're live in Sharm el-Sheikh. Well, good morning, everyone, and welcome to Bloomberg Surveillance early edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News with Alice Atkins. Hi, Alice.
Hi, Francine. Malaysia's political leaders now have until 2 p.m. Tuesday local time to decide on a prime minister. The king has extended the deadline by 24 hours after Saturday's vote resulted in the country's first ever hung parliament. Opposition leader Anwar Ibrahim says he has the numbers to form a government despite falling short of a simple majority. The COP talks in Egypt have ended with an agreement to help developing nations face the devastation of climate change. Although the deal for a loss and damage fund paid for by rich countries is seen as a breakthrough, negotiators failed to agree further cuts in CO2 emissions. The UK government says it isn't seeking a new Swiss-style relationship with the EU. The pushback comes after a Sunday Times report that Prime Minister Rishi Sunak's administration is exploring closer economic ties with its European neighbours. Switzerland is a member of the European Free Trade Association and participates in the single market for most goods. The UN's atomic agency says powerful blasts have shaken the area around Ukraine's Zaporizhzhia nuclear power plant. The IAEA says some buildings and systems were damaged, but none critically. Ukraine's nuclear regulator says Russian forces struck the facility. Moscow blames Ukraine for the shelling. New court papers show Sam Bankman-Fried's bankrupt crypto empire owes its 50 biggest unsecured creditors a total of $3.1 billion. According to the redacted list, entities linked to FTX owe their single biggest creditor more than $220 million. Investors continue to pull funds from digital asset exchanges despite efforts to reassure markets about their stability. Walt Disney is bringing back former CEO Bob Iger to run the company. The 71-year-old spent more than 4 decades at Disney, including 15 years as chief executive. The company says he's agreed to serve for 2 years, succeeding Bob Chapek, who is leaving immediately. Disney shares are heading towards their worst annual loss since at least the 1970s. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine?
Alice, thanks so much. Alice Atkins here in London. Now, negotiators at the UN COP27 Climate Summit have reached a historic last-minute deal on payments for climate damages. Let's get out to Bloomberg's Jennifer Zabajadra, who's in Sharm el-Sheikh. Jen, finally, there's something new that's been agreed, but it's not the all-encompassing deal that many were hoping for.
It's not, Fran, and you know that because you were here for the first week. But, developing nations that we've been speaking to were noting that it took 30 years to even get loss and damage on the agenda. So the fact that the summit is ending with a fund in and of itself is seen as a positive. We heard that from Pakistan's climate chief, who noted that this is the first positive milestone. But now the work will really begin on how to actually structure this. And that's going to be key for the transitional committee that is going to be tasked with making, deciding what this is going to look like heading into COP28. But really ending this COP, there's a lot of disappointment from a number of people who say that this COP really failed to deliver a stronger stance on mitigation. We know that there was a lot of calls from India, from the US, from the EU to potentially include the language of phasing out all fossil fuels. But instead, the final text includes just phasing down unabated coal, which is the same text that we saw from last year in Glasgow. And we heard Frans Timmermans specifically noting that it's not enough of a step forward for our planet. So there's really a lot of different opinions out there right now. We did see a lot of progress on climate finance fronts for countries like Vietnam and Indonesia, but still, Fran, not exactly the outcome that I think everyone was hoping for ending this COP.
Jen, thank you so much. Jennifer Zabazaja there for us in Sharm el-Sheikh at COP27. Now, stocks lower today amid concern that China may tighten COVID curbs after a string of reported deaths. Investors are seeking shelter in the haven assets of treasuries and the dollar. And we're joined by Saxo Bank's chief executive and founder. He's Kim Fournais for an exclusive conversation. Kim, as always, thank you so much for giving us a little bit of your time. You make us smarter on some of the macro trends and some of the opportunities out there for the market participants and the bank. What do you see unfolding over the next 6 months? How ugly will the markets get?
Well, clearly we're still in quite a bit of a turmoil, and I think many different things are hitting us: climate crisis, wars, inflation, rising interest rates, soft stock markets, and I think it'd be unlikely, also with everything we see in the crypto market and so forth, that there would not be some fallout from this, because clearly debt levels in the world are bigger than ever before. Interest rates are going up, so servicing the debt should be more difficult. Clearly, we have not seen any specific signs yet, at least not the grave ones. But I would anticipate that we're not kind of done with this. There will be delayed effects from everything we've seen now. And obviously, there's still a lot of money, but I think it'll be more difficult in this environment not to see things further accelerating on the downside.
So, Kim, what are you most worried about? I know, of course, it's inflation, it's the terminal rate, but do you worry about leverage, that parts of the markets are fine when interest rates are at 1%, even 2%, and it gets much trickier at 5%, 6%?
I'm sorry, could you say that again? I didn't hear. There was a problem here. I'm sorry about that.
Yeah, Kim, I was going to ask you whether you saw a lot of concerns on leverage, whether parts of the markets are over-leveraged, so that it's there could be a liquidity squeeze or a crunch similar to 2008 if parts of the markets go under as interest rates increase rapidly.
Sure. Well, I think exactly that leverage is there due to much debt, because debt really is leverage. And as debt levels have never been bigger, of course, this is a big problem when interest rates are going up. So I do think we will see some fallout from that. And I think it will obviously particularly hit the ones who do not have the proper solvency or capital, or do not have appropriate cash flow. So I would think of it unlikely that we do not see some fallout from that leverage, and we'll see potentially something that could even end up in certain areas to be a credit crunch or something.
The FTX fallout is pretty incredible. I know Saxo offers some crypto trading opportunities. How do you look at this pretty incredible story over the last 3 weeks?
Well, I think it's an incredibly and terrible story. Unfortunately, another one in quite a long line of unfortunate events. Again, the way we offer crypto trading in Saxo is very different. It's really linked up against the main currencies, US dollar, yen, and euro. So we actually having a compliant product. We don't have any cold or hot wallets or anything. So, and we offer very tight spreads, but also that means that you have best execution. you have basically a compliant product. And I think what's the problem within the crypto industry on a larger scale is the fact that all the consumer protection, all the best execution, all the prospectus, knowing what you're buying and so forth, it's just not there, and it's not being regulated. And we have seen not one but many fallouts, FTX just being a really, really big one here. And it's kind of obvious, we've talked about this for a long time, but it obviously needs regulation, and we need to make sure that when people are taking an onboarding client and client funds, well, they need to also be responsible and make sure they keep the proper capital and liquidity levels.
But so, Kim, what does it mean specifically for Saxo Bank offers? Are you cooling off crypto until there's more regulation? Does it impact the services that you will bring forward?
Actually, the way we do it is we are a fully licensed bank, and we do deliver a compliant product. So we call it crypto FX. So you can trade Bitcoin, Litecoin, Ethereum against euro, yen, and US dollars. And that business has not had any issues. We do not have any cold or hot wallets, and we don't offer that for clients. So you can say that we trade cryptos in a compliant and regulated manner, and we also offer the exchange traded products on this. So we don't really we've not experienced any fallout from this, other than what everyone can see, which is obviously very soft markets and again an unfortunate situation for the whole marketplace, where global valuations have gone from 3 trillion to, I don't know what it is now, maybe 600-700 billion. So there's still a lot of money in there, but they're flowing out quickly, and we can see a lot of people have lost many money, and that's a sad thing.
Kim, first of all, congratulations on Saxo Bank on its 30th anniversary. What happens next for Saxo Bank and how you want to grow? Will you IPO? Will you be part of a SPAC?
Well, we are looking. I think my mic went there. We are looking at doing a listing, and we have announced our intent to list. So we are working hard on that as we speak. But right now it's really about running the business and trying to have a good situation there, where we completed the bank migration a few weeks ago. And this has been a very, very big effort for us. So we're really focused on just working with the clients. We have a lot of additional products, platforms, services that we are rolling out across the board. So we are working very closely with our clients and our partners, and obviously navigating difficult times. But I think Saxo is in a very good shape, and eventually we would like to be a listed company. And that is what we're pursuing full speed ahead, even though that the external circumstances are obviously not so optimal for that. But the internal ones, Saxo Bank is having a good business, and I feel very good about the future after 30 years.
So Kim, and again, congratulations. How fast do you think you can list, and where would you list, and how much would the bank be valued at?
Well, we are working on this as we speak, and there's not so much information I can provide on this at this stage. It's not going to be this year, so hopefully beginning of next year we'll come out with some more firm information on what all of that looks. We are aiming for Amsterdam Euronext, so at least that part of it is pretty clear. But again, it's not happened until it happened. Many things can. I mean, we live in an unpredictable world. The good thing is that Saxo is a profitable business. We have very, very good capital levels. So we are very stable. We don't need to do anything, but we do believe that it will be a good idea to come out with a smaller slice of the business and create liquidity and a structure for future shareholders. And also we did buy Bank some years ago, which was successfully integrated. And to get acquisition currency to maybe do something like that again would be helpful for us as well.
Kim, thank you so much, as ever, for your time and wisdom, and also unflappable. Kim Fournais, readjusting his mic, the chief executive there and founder of Saxo Bank. Coming up, COP27, over and out. We'll wrap up the finale of the climate conference. That's coming up next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the 2022 World Cup has kicked off in Qatar. A lavish opening ceremony was followed by the opening match between the hosts and Ecuador. It's a culmination of a 12-year build-up that's been marred by controversy over the initial bid, human rights concerns, and the environmental impact. Well, Bloomberg's Simone Foxman was watching from the stands. Simone, first of all, what did the opening ceremony and match say about Qatar's ability to manage this massive event?
Well, as a test of Qatar's ability to manage a major sporting event, I think all went pretty well. Yes, there were quibbles. There was a lot of traffic getting to the event. Some of the food options ran out. But for the most part, there was an exciting opening ceremony. Match on the field, a little less exciting. Qatar clearly outplayed really from the start. 2-0 Ecuador winning that match. And that likely cuts off Qatar's chances for advancing out of the group stage in the tournament. But really clear to me was who was in attendance on a geopolitical front. There were lots of regional leaders here. We saw a picture published by the Turkish state-run news agency of President Erdogan shaking hands with President Abdel Fattah al-Sisi of Egypt for the first time. There are tensions, massive tensions between those two countries. And then we also saw Saudi Crown Prince Mohammed bin Salman. He was just 2 seats away from the Qatari ruler, and he was in close discussions with FIFA President Gianni Infantino. I wonder what they were talking about, the potential for a Saudi World Cup, maybe.
I mean, maybe certainly that would cause more controversy. How are corporate sponsors responding to an event that's garnered so much public criticism, Simone?
Yeah, if this one's been controversial, imagine what would happen if there was a World Cup in Saudi. But, you know, look, I reached out to 76 sponsors, both of national teams based in the US, Canada, and Europe, and also to FIFA sponsors based in those same places, and places where the criticism of human rights abuses in Qatar has been widespread. And I less asked them about, you know, the rights issues themselves than I did, how are you responding to this? Are you changing your global marketing strategy? The vast majority said no, or just plain didn't respond to me. I found just 13 teams said they were changing their strategy in order to account for human rights, and only three of those brands actually had ties in some way, business ties to Qatar. So as much as corporate CEOs go out there and they talk about ESG and social impact, you know, what I found was ad dollars, 5 billion viewers potentially watching the World Cup. There's not much change in the way these companies say they're going about things.
Simone, thanks so much. Simone Foxman there joining us from Doha. Now, coming up, COP27 over and out. We'll wrap up the finale of the climate conference. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the COP talks in Egypt have ended with an agreement to help developed nations face the devastation of climate change. Although the deal for a loss and damage fund paid for by rich countries is seen as a breakthrough, negotiators failed to agree further cuts in CO2 emissions. Now, we're joined by Nazmira Mullah, Chief Sustainability Officer at 91. Nazmira, thank you so much for joining us. First of all, we have heard quite a lot about GFANs and the fact that maybe some money behind the transition are, if not getting cold feet, wondering what the parameters of this is. Are you a bit disappointed that the move to sustainability or to greener technology and transition could have more teeth?
I think it was always going to be a long journey. It was never going to be as clear as we all commit in the same year and everything moves in a straight linear line. So I think there are some disappointments from this COP, but there are also some major wins. As you noted, the Loss and Damage Fund, the announcement on that, I think is a big positive. I think also the announcements around plans to reform the global financial system, particularly around the MDBs to provide more climate financing, is also a big positive. There were some areas which were not as positive, the fact that there's not as much progress around mitigation commitments, the fact that there's no agreement on peaking emissions by 2025, but I think what gives me the most hope at this point is this continued push to just build out the new technologies, to get the mitigation technologies onto the ground.
Nazmira, Republicans have also signaled that they'll use their very slim majority in the House to make it maybe more difficult or make life harder for companies embracing ESG. Is this a real threat?
I think that we need to differentiate between the concerns around ESG and potentially concerns around moral values being imposed on portfolios and the idea of investing in the new green technology. I think a lot of what we're seeing from the Republicans is concern around phasing out of fossil fuels, which is a big part of what needs to be done. But the part they seem to be very happy to go along with is just building the new green technology. So the biggest builder of renewable energy in the United States is Texas. If you look at the Inflation Reduction Act, there may not have been a whole lot of support from the Republican Party, but there are many Republican states that are going to take massive advantage of the benefits of that act.
But do you see any of this actually affecting the flow of capital potentially away from some of the ESG goals?
I think that's something that we'll have to monitor as it goes along. I mean, I think as far as COP goes, as far as COP27, I think the focus on mitigation is being clear. I mean, we saw that with the Indonesia transaction. If you look at South Africa last year, it was much more combination of the shutdown of old coal-fired power stations and building the new energy. Indonesia is much more around how quickly they can build new renewable energy. And I think that's where the focus is increasingly shifting at this point.
Nazmira, overall, what kind of adjustments are you making to your allocations to reflect some of the developments at COP27? I know they were slim, but there's a couple of things that happened and were signed off on.
I think one of the things we saw at COP is this continued rhetoric around the need to fund the emerging market transition. What worries me a little bit is you haven't seen capital flow in anywhere near the quantum needed for that. So we know that portfolio flows into emerging markets have been challenged because of the macro, but the blended finance flows are also down. So the latest report from Convergence shows blended finance flows into emerging markets, particularly around climate, but in general, are down if you take the last 3 years compared to the previous 3 years. And that's exactly the opposite of what we need. So now we talk about these JETPs, and yes, they're important and they're catalytic, but we aren't seeing substantial amounts of really concessional capital coming to bear as yet. I'm hopeful we may see more, but it hasn't happened as yet. So what I'm doing is we are looking at allocating towards the companies and countries that are doing the most to transition, because a large part of that transition can be done by the commercial private sector, and that's what we need to support.
Great. Thank you so much, Nazmira Moola, their Chief Sustainability Officer at 91. Now, Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller and Kailey Leinz in New York. Anna Edwards is here in London. And of course, a lot of the show will be focused on the UK. A Brexit debate does seem to be returning at the forefront of UK politics. Our Lizzie Bergen is also at the CBI conference in Birmingham. And then stocks still dropping on a lot of concerns surrounding China. Dollar is definitely seeing a bid 1,291. We chose the Bloomberg US Dollar Index. And then Disney, look at that, gaining 8% after they went and got back the former chief executive. This is Bloomberg.
The rally could continue. I do think it is a bear market rally. I mean, it could go to the end of the year.
I think we have to be a bit careful.
I think we're still going to be facing an awful lot of volatility in 2023.
Really what we're dealing here is potentially with an earnings decline that is not yet priced into the market for 2023.
Given the structure of the S&P, there are huge opportunities underneath the surface.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Disney's surprise. Bob Iger is back as CEO after a string of disappointing results and a slumping share price. Far from zero, China's first COVID-related deaths in almost 6 months have sparked concern that Beijing could see a return to heightened restrictions. and $3.1 billion. That's how much FTX owes its 50 biggest unsecured creditors. We've got the latest on the ongoing crypto crisis. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Good morning to you, Kailey, and to Matt. And Kailey, it seems another week, and we've turned a bit of a corner on the China story, now worrying about the reaction function we're going to see from Chinese authorities, whether it'll be the old COVID zero playbook as cases rise.
Yeah, Anna, it's definitely an abrupt U-turn on what had been optimism about the reopening of the Chinese economy. We'd seen a massive rally in Chinese-sensitive stocks as a result, but now concern back to the forefront that tighter curbs could go into place after those reported deaths over the weekend. So that dragged heavily on risk sentiment in Asia overnight. The Hang Seng China Enterprise Index down about 2%, and the losses were even greater for technology stocks in particular, which had seen really big gains over the last several weeks. The Hang Seng Tech Index down about 3%. And of course, it's filtering through to other asset classes as well. In foreign exchange, the Chinese yuan weaker against the US dollar by about 7/10 of 1%. 717 rather is where we trade. And of course, there is a read through to the commodity complex, given so many of these commodities are very sensitive to the China demand story. Iron ore specifically, with those futures down about 3.5% overnight to around $95 a ton, Matt.
All right, and we're watching, of course, the yen weakening against the dollar as well right now. Dollar strengthening against a number of other currencies. Here you can see in the second row, the Bloomberg U.S. dollar index now up to 1291, back up to 1291, so climbing ever higher on concerns about the COVID crackdown in China, the about face that we saw there, and we're going to talk about that in a little bit. S&P futures down on that as well right now, about 0.5%. We were up about 0.5% on the cash trade of the S&P on Friday to about 39.65. We're losing a little bit of that steam right now. NYMEX crude is also coming down. If there is a continued slowdown in China, we don't have that reversal that may have been a little bit of a lift for prices, and so we're back down below $80 a share at 79.71 on West Texas Intermediate. Finally, Bitcoin right now trading just above $16,000, $16,093. It had fallen below that, and I'm sure that's going to affect a lot of companies like Riot Blockchain and Coinbase in today's trade, but we're definitely watching this $16,000 level, which had been until now a support. Anna, what do you see in Europe?
Yeah, well, here in Europe then, Matt, we've seen 4 weeks of decent gains across European equity markets. Have we drawn a line under that, though? Are we now in a consolidation phase? Are we done with the rally into the year end? Still in November, of course, but this is what we've got with European stocks right now. Just down by 0.1% on the FTSE 100. The CAC a bit more than that. The DAX down around 0.5%. We are off earlier lows of the session, so we were down weaker than this a little bit earlier on in the day. Barclays talking about 2023 being a better year for European stocks, saying by the end of the year, at least, we will have worked through some of the headwinds, but that seems a very long way off right now, doesn't it? This is what we're dealing with here in Europe right now. And the FX moves have been big overnight, and Kailey and Matt have talked about some of those. So let's get to what that's doing to European assets. Maybe the pain of that strength of the dollar has been one that US corporates have been feeling. Some European companies feeling it as well, of course. And we've got the pound here down by 0.7% against the US dollar as we see a return to that strong dollar vibe. The euro also down by 0.9%. So this really is a strong dollar story, not weakness in these particular currencies today, and the strong dollar being driven, of course, by what Kailey was talking about over in China and the fight against COVID that continues there. Brent crude down by 0.6%. Matt had the WTI price. We're down well below $90 a barrel. Had we seen support coming through from an expectation of a pivot in the way that China deals with COVID, we've seen that Goldman Sachs has reduced its call on where energy goes from here and bringing down its oil price call by around $10. Julius Baer Group up by 0.6%, so outperforming the broader space. We heard from them in terms of numbers, reporting to the markets today. The money manager based in Switzerland, in line with expectations, really, as far as its targets are concerned, not changing those, but saying it sees better things in terms of the net new money or the new money coming into the business, Matt.
All right, very interesting stuff. We're going to continue paying very close attention to that as we do all of the wealth management stories, of course, around the world. A lot of those wealth managers own Disney and had been disappointed with the CEO, Bob Chapek. Well, now Disney is bringing back its former CEO, Bob Iger, to run the company, which is a surprise move by the board after a string of disappointing results by Chapek. Iger stepped down as chief executive in 2020 after leading the company through a period of enormous growth over 15 years. Alex Webb of Bloomberg Bloomberg Quick Take, joins us now for more. So this was unexpected, and we got a new activist shareholder building up a bigger stake as well, right?
Yeah, the thing we'd seen over the course of the pandemic was that early on, we had activists come in and say that Disney needs to be more like Netflix, i.e. become a growth stock, cut the dividend, invest the capital in content for the streaming service Disney+. And at that stage, Disney had been trading around the 20-something times forward earnings. Netflix was 50-plus times forward earnings. Disney subsequently overtook Netflix on that basis. But what we've seen since then is that growth stocks have been punished as interest rates have increased. So the question that Iger now faces is will he do better to take more money away from Disney Plus and increase the dividend? Or should he still try to position Disney as a growth stock at a time when it isn't particularly rosy for those kind of equities?
Yeah, good morning to you, Alex. Yeah, as money becomes more expensive to do new things and to invest in new stuff and in growth. So what can Disney change then from here?
Well, it can take money away from Disney Plus and decide to increase the dividend. There are some internal cultural things. There's a lot of basically communication with capital markets that perhaps needs to improve. What is the purpose of the spending? What is it going to yield over what sort of time frame? Now, at this stage, people are not looking as much for stocks that have longer returns. They want stuff that's more immediate, and so that might be the first thing Iger needs to look at.
All right, Disney shares up 8.5% right now in pre-market trading. Bloomberg Quick Takes, Alex Webb, thank you so much. Let's turn back now to the China story. The country's first COVID-related deaths in almost 6 months are sparking concern that Beijing could see a return of tighter curbs. Enda Curran, our chief Asia economics correspondent, joins us now from Hong Kong with more. So, Enda, how realistic is it that we see a reopening of this economy if deaths might be on the rise?
Well, it's going to be a big test of this recent COVID zero pivot, Danny. As you mentioned, cases are surging now. We've had those first fatalities in 6 months. We're heading into winter time. Officials are obviously at a very delicate stage because on the one hand, of course, we had the signalling from the top of government that there could be some more targeted kind of restrictions to slow down the pace of COVID spreading rather than the blanket lockdowns we've seen in the past, less mass testing, less kind of lockdowns. But we have seen now already some reversal of some of that. A city near Beijing, for example, our colleagues reporting quite widespread restrictions in place there, even though they had been easing as a city themselves in recent weeks. So it is a big test. Remember, there's a lot on the line politically. China has made a big deal out of their overall fatality rate being so low compared to other parts of the world, especially the US. But of course, we now know there's so much pressure on the economy, both from the real estate and the COVID zero lockdowns, that there will be a lot of pressure on the government in terms of how we do handle this. And I think we're heading into how the government handles it, and we are obviously heading into a very critical period over the coming weeks as we go deeper into winter.
Yes, and as far as the market and the economic fallout from this is concerned, of course, the last couple of weeks have been dominated by markets rethinking China and thinking there was going to be a pivot away from the really harsh COVID-0 policies towards something looser, that would pay dividends for the Chinese economy. Some of that prize just gets pushed into the future, I suppose.
Well, it does, but the state press this morning, in terms of conflicting signals, Anna, the state press this morning were saying, look, let's not go back to those blanket kind of lockdowns or restrictions that China has become known for earlier in the pandemic. Try to do something more targeted, but obviously officials on the ground must be wondering how can they figure that out? How can they control cases without reverting to these big broad-based lockdowns? And this is where the market story comes in. There has been optimism that when China does pivot away from COVID-0, the economy recovers and you're back to investing in the China story. But it must be said that right now, China remains to have in place some of the world's most strictest measures to control COVID, and it does feel like we remain some time away from a full and complete exit from the COVID-0 strategy.
Enda, thanks very much. Bloomberg's Enda Curran coming to us from Hong Kong. Let's get now the latest on the crypto situation. New court papers show Sam Bankman-Fried's bankrupt empire owes its 50 biggest unsecured creditors, customers that is, a total of $3.1 billion. Anna Herrera, Bloomberg senior crypto editor, joins us for more. So Anna, two of those customers had more than $200 million on FTX's books.
Yeah, so we're trying, obviously, everyone, I guess, is trying to figure out who these creditors might be, because there might be ripple effects, right? Like, they might have the creditors, too. So, this is clearly a sign that there might be some more contagion coming.
there might be some more contagion coming. What do you make of the fact that Bitcoin's dropped below 16,000? I mean, on one level, there's been a slow and steady drop. On another, it seems fairly controlled compared to the rest of the chaos that we've seen in crypto.
Yeah, it's quite interesting. It seems maybe that people are distinguishing between crypto, the people and the companies, and crypto, the asset. And maybe you would have imagined it would have dropped to like maybe 10,000 if we imagined a chaos of similar, proportions.
Okay, more analysis on crypto later in the program. Let us thank you then to Bloomberg's Ana Herrera. Let us get back to another story we're following today. Negotiators at the UN COP27 climate summit have reached an historic last-minute deal on payments for climate damages. Let's get to Bloomberg's Jennifer Sabasaja, who joins us now from Sharm el-Sheikh. So, Jen, what has been agreed? They've managed to agree something around the amount of support to poorer countries, but not around increasing targets for emission reduction.
Exactly, Anna. And this was a win significantly for a lot of developing nations who have said for 30 years plus that they wanted loss agenda on the agenda item. So this was significant that a fund was actually created out of this summit. And what it will do is sort of the next step for the transitional committee that is going to be formed leading into COP28. Right now, we don't know the financing structure. We don't know which countries are a part of it. So still a lot of work to go on that. But when just talking about the failures, the disappointments that people are feeling out of this COP, it was really on this front with mitigation. There was not stronger language taken from COP26 in Glasgow this year. There was not a decision to include the term phase out all fossil fuels and just phasing down like what we saw last year. So a lot of disappointment from a number of leaders who were hoping that would get us on a better path to keeping temperatures below that 1.5 degrees Celsius. But there were still some positives coming out of it. There was a number of climate finance projects that were announced by the private sector, also some public sector support for countries like Vietnam and Indonesia to transition out of fossil fuels. So some positives and a lot of negatives, but a lot of mixed results coming out of this COP27 and really a lot to still work out going into COP28 that is going to be hosted in the UAE, which is, of course, a major oil and gas producer. So many climate scientists and activists are worried that maybe this goal that we had is maybe diminishing just leading into the next year.
All right, Bloomberg's Jennifer Sabasaja reporting from Sharm el-Sheikh, Egypt. Thank you so much. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. And really, a lot of these names come back to that China story. Concern around the reopening maybe not happening as cases and deaths start to tick up. So that is weighing heavily on Chinese technology stocks with listings here in the U.S. Alibaba down 3% for those ADRs. JD.com down nearly 5%. And it is also weighing on casino operators that have heavy revenue exposure to Macau. Las Vegas Sands, Wynn Resorts, each also under pressure, down between 3 and 3.5% in pre-market trading. And finally, one final note on the crypto story. We were just discussing with Ana Herrera how Bitcoin is sub 16,000. You're seeing a lot of crypto names under pressure as we contend with the fallout of the FTX collapse, and that is weighing on the shares of another crypto exchange, Coinbase, of course, the largest one that is public. Those shares down about 5% before the bell, Anna.
So coming up on the program, we will get back to the subjects of energy, very topical here in Europe, and business, what it wants from governments at this point. Greg Jackson joins us, founder and CEO of Octopus Energy, an energy provider here in the UK. We'll also talk about markets with Jeffrey Yu, BNY Mellon senior strategist. What is he making for the big pivot back into the dollar this morning that we're seeing around those China headlines? Plus, on crypto, we'll get back to that story. Lex Sokolin joins us, Consensus head economist. We'll get his perspective on the latest FTX news lines. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Now, the UK Prime Minister Rishi Sunak is set to speak to business representatives at the UK's largest business conference today. In fact, within the next 15 minutes or so. Surging energy prices are among the topics on the agenda. One of the keynote speakers at the conference, Greg Jackson, joins us, Octopus Energy founder and CEO. Greg, when we look at the government and its relationship to business right now, clearly your business very impacted by the budget last week. So what are you looking to hear from the Prime Minister when he speaks a little bit later today?
And clearly in the short term, it's important that we do everything we can to help consumers through this crisis. the impact on inflation, on their spending power, and critically on their ability just to pay their bills is foremost in the short term. But we also have to build our way out of this, and the answer is being able to deploy dramatically more capital to build cheap renewable energy here in the UK, and indeed this is what we need around the world. It's not only going to help tackle climate change. You heard from COP just now, and the critical importance now of getting on with replacing fossil fuels with renewables, but also it helps energy costs and energy security.
Right, and with that in mind, you talk about needing to build our way out, cheap renewable energy. The government has just put a 45% tax on businesses like yours through the electricity generator levy. Where does that leave your investment plans?
Yeah, I mean, at the moment, it's very hard for any company to justify the windfall profits that far exceed anything that was planned, when at the same time you're seeing the damage done to consumers' lives and to our economy. Coming up with a fair solution is important, and these kind of sticking plaster solutions are okay. What matters is giving us the ability to deploy dramatically more investment to grow forward. And at the moment, in the UK and around the world, we face sclerotic grid infrastructure, which means we can't get these new renewables built and connected. We face planning issues that are unnecessary. We've got to learn from COVID, where we took the 15-year regulatory process of the vaccine, did it in a year. We've got to take the 7 or 8 year regulatory process for renewable building and do it at the time it takes the engineering, which is a year.
Greg, I keep reading that, at least from an investor's perspective, the UK and the European energy situation isn't as bad as had been expected. Have we avoided a worst-case scenario for now?
We're right in the middle of the storm at the moment. I think what's happened is, Europe responded quickly to the need to start reducing dependence on Russian gas, filling up a gas storage in Germany and across Europe, rapidly building new supply chains to get gas into Europe to replace that Russian gas. We've had a mild start to the winter in the Northern Hemisphere. And so far, the crisis this year is like, prices are still astronomically higher than they were in the past. But, we can be slightly more positive. What we don't know is what the rest of the winter holds. So what really matters now is, are we going to be able to, leave this winter with some gas in storage ready for next year? Or is bad weather going to hit, and then we're going to be scrabbling for more gas?
Are households prepared? I mean, should we be making more preventative, taking more preventative measures, such as insulation?
Insulation takes time. I mean, the first thing is there are lots of low-hanging fruit that households can do. Whether that be, for a lot of households, they can reduce their thermostat by 1 degree C. It will reduce consumption 10, 15% very often. And barely make a difference to comfort. Other households can adjust the way that their, for example, gas furnace, the gas boiler works, and again, save another 5-10% of gas. Octopus's customers in October used 37% less gas than last year. That's a combination of warmer weather, but also a lot of behavioral change. What we don't know is how long that'll last through the winter.
Yeah, so interesting to see kind of those demand reductions. Meanwhile, Greg, Octopus is in the process of acquiring Bulb, which is another UK energy provider that collapsed as prices soared. The government had not hedged for those customers. So how did they make that deal attractive to you?
Yeah, so I think, first of all, I can't talk a lot about kind of conversation we're having with government. It's going through a technical legal process at the moment. But I think government rules in the UK prevent hedging. And this winter, that has certainly cost the government a lot of money. And the sooner that they can find a route to putting Bulb back into the private sector, the sooner they can give certainty to taxpayers.
Okay, and finally, Bulb obviously is not the first that has succumbed to this very volatile energy price environment. It may not be the last. Do you expect we will see more providers going bust over the course of this winter, possibly the next?
Look, last winter, there were doommongers saying that we'd end last winter with less than 10 energy providers. There's still well over 20. So, I think it's a fool that makes those predictions. But look, the key thing here is pretty much every company that went bust did so because they were not hedged. We need the regulator and the government to make sure companies are hedged. It's the equivalent in financial services of, selling long and buying short. And without a decent regulatory oversight, you're always going to have vulnerabilities. So the one thing we're calling on is regulatory focus on hedging, and that would secure the sector dramatically better than before.
All right, Greg Jackson of Octopus Energy, thank you so much for your time today. And again, we are watching for remarks from CBI from the UK Prime Minister Rishi Sunak. We'll bring you any headlines from that when it begins. Meanwhile, let's keep you up to date with other news from around the world with the first word. In a newspaper interview, Germany's defense minister says the country is offering Patriot missile defense systems to Poland. Last week, a strike killed 2 people in a Polish village near the Ukrainian border. Germany says it also intends to extend a deployment of Patriot batteries in Slovakia through 2023. The UN's atomic agency says powerful blasts shook the area of Ukraine's Zaporizhzhia nuclear plant over the weekend. Former Treasury Secretary Larry Summers warns U.S. policymakers to focus on building the country's own economic strengths in its contest with China, rather than attacking its adversary. Summers tells Bloomberg the U.S. should instead concentrate on its own innovation, infrastructure, education, and challenges such as opioid deaths. The world's biggest single sporting event, soccer's World Cup, has begun in Qatar with a lavish opening ceremony. The Gulf state's been under intense scrutiny leading up to the tournament over the treatment of migrant workers who built 7 new stadiums, as well as concerns about human rights and its criminalization of homosexuality. And it wasn't the start the hosts were hoping for on the pitch either, beaten 2-0 by Ecuador in the opening match. And American musician Ye, of course formerly Kanye West, returns to Twitter after a 2-week hiatus from the social network, and the new owner Elon Musk welcomed him back to the platform. Ye's account had been temporarily suspended and restored at the end of October, which Musk said was not his decision. Ye's earlier suspension had been due to an anti-Semitic tweet. And of course, it's not just Ye that has made his return to Twitter, or at least could in theory. Former U.S. President Donald Trump, who had been banned from the platform in January of 2021, also has had his account restored. But I just checked, Matt, he has not yet tweeted. Of course, he tends to stray toward Truth Social these days.
Yeah, these days. But the question is that going to be enough reach for him? Does he need to go back to Twitter? Elon Musk had tweeted a pretty cool meme with Lois from Family Guy, like shaking and looking at a prescription drug bottle, like she needs those drugs. Does Trump need Twitter? Maybe he will if enough people aren't reading him on Truth Social. Certainly he's not getting swing voters that way, Anna.
Yeah, I mean, some of the memes that Musk was posting are funny. Some of them seemed in pretty bad taste. But interesting to see the poll that he conducted around President Trump, then Kailey, and the fact that he'd said he was going to set up a board to evaluate this kind of stuff, and then he just decided to decide via asking his followers. And would you believe it? The result was 48-52. That seems to be the kind of divide we get in all kinds of political situations these days.
Yeah, definitely a split, Anna. But on the point of Elon Musk's decisions, it is interesting to see him restoring accounts that frankly were deactivated for a reason because of concern around the spread of false misinformation and also anti-Semitic and other hateful content. When Twitter already is contending with advertisers pulling back from the platform because they're uncertain around the company under the leadership of Elon Musk, concerned that perhaps their advertisements will be running next to misinformation or hateful content, it raises a question of the business decision of restoring some of these accounts and if this is just going to push people further off the platform.
Yeah, it's going to have an interesting impact on that ad revenue. We'll watch that very carefully. Back in the markets then, we'll talk to Jeffrey Yu next, BNY Mellon Senior Strategist. We're seeing money flooding back into the dollar today. All those headlines around China, of course, making investors very nervous about what the reaction function is of the Chinese government around COVID. Yes, cases are rising. Sadly, deaths rising too. What kind of lockdown strategies will we see? Will they look like the old playbook that we've known through COVID-0 from the Chinese government? We'll get back to that conversation shortly. And what does that mean for investment strategies more broadly and globally? This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Disney's surprise, Bob Iger is back as CEO after a string of disappointing results and a slumping share price. Far from zero, China's first COVID-related deaths in almost 6 months have sparked concern that Beijing could see a return of heightened restrictions. and $3.1 billion. That's how much FTX owes its 50 biggest unsecured creditors. We've got the latest on the ongoing crypto crisis. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Matt, the crypto story, the Twitter story, plenty of individual business stories and indeed stories that risk contagion to follow. But in terms of the broader markets, we've got this Chinese story coming through and having a bit of a downward impact on US futures. At least something is pushing them lower.
Yeah, no, the Chinese story is huge, right? Because it turns around a lot of the narratives that started to look like they were driving the market. For example, we thought, okay, there are a lot of short positions now in the US dollar. The greenback is going to start to weaken against other currencies around the world. Now we're seeing the US dollar index, the Bloomberg US dollar index here in the second row, strengthen against other currencies around the world. You may also have thought, okay, if they start to unlock big cities in China, a ton of people are going to be driving. There's going to be huge gas demand. We can expect oil to start to bounce back higher as demand comes back in the picture. Well, oil is now back lower, again under $80 a barrel for, this is West Texas Intermediate and NYMEX crude, but you can see the same thing on the global benchmark Brent. We're coming down on concerns that demand just isn't going to be there regardless of the supply cuts that OPEC puts into force. All of this, of course, is pressuring S&P futures in a downward manner as well as other indexes around the world. Right now, we're at 39.51 on futures. We're at 39.56, I think, on the cash trade. We were up about 0.5% on Friday, but that's now turned back around. And then Bitcoin also looking at some downward pressure, but still higher than 16,000. We had dipped below 16,000 temporarily. That is seen as a support level for the cryptocurrency, but it's now back up there. And the question is, will this contagion spreading out from FTX, all the customers that were owed $200 million, $100 million, $50 million and looking to put a big zero under that, is that going to hurt across, I think as someone put it earlier, are those creditors going to have creditors of their own? Kailey, what do you see in terms of the pre-market effects?
Well, I have to begin first with one of the shock corporate stories of the day, and that is Disney. A surprise ouster of Bob Chapek, the CEO. The prior CEO, Bob Iger, who stepped down in 2020 after leading the company for 15 years, is back in. He will be CEO for another 2 years while they search for a permanent replacement. He's going to be charged with turning things around for Disney stock, which is down more than 40% so far in 2022, but it is higher by 8.2% on that surprise news of the morning. Massive move for Disney. But back to the crypto story you were mentioning, Matt, the kind of ripple effects, contagion concern around FTX and the fact that Bitcoin prices are lower. That's dragging on really the entire crypto complex, including Coinbase, of course, a rival exchange, which is down 5.2%. And then to the China story that you and Anna were mentioning off the top, they're concerned that the reopening of the economy maybe is not actually going to be coming so soon as cases rise, and the first deaths in the country were reported in 6 months over the weekend. So JD.com down 5%, Alibaba ADRs down about 3% as well, Anna.
Kailey, here in the European session, then I just wanted to show you the European side of some of the big macro themes that Matt was talking about a moment ago. So we've got the European stocks on the back foot, down by 0.2%, just as we see US futures a little bit weaker. The big global story coming out of China seems to dominate. That pushes money into the dollar, the perceived safe haven of the greenback, and that takes out the pound and the euro. Both the pound and the euro then down around 0.8%, against the US dollar. That's quite a substantial move in one session for those currencies. And Brent crude, Matt was talking about WTI. Here's Brent down by 0.6%. Again, this is related to China, concerns about the growth story there and how long we have to wait for any kind of normalization in the growth story out of China. Goldman Sachs, for example, Kailey, taking down their estimate of where oil prices get to by around $10.
Yeah, really seeing across asset classes the concern reflected about growth in the Chinese economy. But it raises the question of whether good news is bad news is good news, because a reopened China and spurred demand from China could fuel the inflation problem that countries around the world are dealing with. So let's get the assessment now from Geoff Yu, BNY Mellon senior market strategist, who is joining us from London. Geoff, how are you viewing the China story going into 2023 as we have optimism on the one hand about reopening, question marks of if that's even going to happen, and ultimately what it all means for inflation?
Good morning. So I think the overall sense is maybe markets got a bit ahead of themselves in anticipating some kind of a big bang reopening. I think globally we've noted in the past, and we've seen through experience, that a big bang reopening in the middle of winter, and winters in northern China can get very, very cold. You know, it's quite adverse an environment for a reopening. That was always a bit of a stretch. However, you know, right now what I'm watching is, you know, whether Beijing and some other cities at risk right now, they're willing to sort of experiment a bit. You know, there has been a gradual symbolic note of that changes, in a more precise way of managing COVID. You know, they're being a bit more transparent, I guess, about deaths happening. Maybe this is preparing the groundwork for some tough times to come. People are being told, to stay at home rather than ordered to stay at home, at least according to official communiques. So this is going to be stop-start, but a full-scale, let's say, pickup activity. We're still looking at maybe Q2 next year at the earliest.
And when that pickup in activity comes, does that equate to a higher terminal rate, Geoff?
Well, it really depends who you're going to ask, because there probably will be upside surprises to, let's say, services demand and industrial demand in the Eurozone. So I've had to pick between the ECB and the Fed, who needs to revise their terminal views. So from China's reopening, it certainly is probably more to the ECB side. And also, of course, in Asia, that's where you really can revise upwards your terminal rate views and also allow some currency appreciation, right? We're seeing that in the yen, maybe some more interest in the Sing dollar, for example. So different implications for different economies.
And different implications for different assets. Geoff, good to speak to you. What about oil prices down here at 87? I say down because, we've seen much higher prices. 87.07 is where we are on Brent. So once again, below $90. Goldman Sachs taking down their forecast for where oil prices get to. Are different asset classes telling us different things about the global economy?
I really think it does. And also, if you look at oil prices, what's the relationship between oil prices and the dollar, right? So if oil prices, just going down, normally we'd see, well, if it's dollar strength, right, then, that tends to depress commodity prices in general. But right now, I think it's more of a demand story because, we're seeing the dollar weaken, largely due to positioning and valuation issues, and that's normally good for commodity prices, but they're struggling right now. I think that's due to the demand story as well. Again, next year, if China reopens, I do think there's going to be a sting in the tail for prices for commodities, maybe less on the oil side, but on the industrial side, I think that's something we need to watch out for.
OK, commodities, we'll watch that carefully. Back to the dollar. The dollar actually gaining in today's session, as we've mentioned, because of risk aversion. But do you then generally see, well, if the dollar has topped out, Geoff, what does it topped out against? What would be better opportunities in FX right now?
Well, right now, for example, in G10, we're looking at euro dollar, we're looking at dollar yen, for example, yen positioning and valuations. That's something really to look at. Euro, right now, we've 3 months ago, according to our custody flow data and iFlow, we saw euro holdings reach almost financial crisis and sovereign debt crisis lows. At that point, so we're not too positive on the euro either, but that was extremes. But now we're seeing euro suddenly flatten out. This is one of the strongest recoveries we've seen. So yes, valuations and policy crucially quite supportive, but I've had to pick between those two. I'd probably favour the yen strengthen against the dollar rather than the euro at this point.
So if valuations are getting better, where are you finding the best bargains, Geoff? Are there certain sectors that you like? Are there certain regions that you like better than others?
Well, again, just going back to our flow data, right now, equities are still being sold across the board. I'd say two sectors, worth watching right now. Firstly, if it's still stagflation, you want to own sectors, so defensive sectors with pricing power, and I think that's where utilities have come through. And even in the lead up to the week where we were still quite risk off and seeing, so right before that downside CPI surprise in the US, utilities basically globally the only sectors which was in demand. But now of sectors, especially on the consumer side, exposed to China reopening. This could be in Europe and this could be in APAC as well. That's where we're seeing a pickup in interest. People looking at financials as well. If China reflates, if Chinese curve steepens, that could help APAC financials in general. That may be getting a bit too ahead of ourselves right now, but so we'll stick to APAC consumer and also utilities for the time being globally.
What about fixed income, Geoff? I mean, have returns gotten big enough? Have yields gotten big enough for you to think it's time to go back? Or is that period already passed?
I still think we need to be cautious on the corporate space. So if I look at corporate credit spreads, and have they really blown out, pricing and potential a recessionary, driven rise in bankruptcies, globally, especially in Europe, at this point, I think that's something we need to be quite cautious on. The repayments for Teltros, last week, what impact is that going to have on overall liquidity in terms of funding credit in the Eurozone? That's something we're still quite concerned about. However, if we go back to APAC, especially in the credit sector, especially in the property sector for credit, that's something something that clients are looking at quite aggressively because of the widening that we've seen, and with the support announced by Beijing for property. Maybe we've seen enough widening in corporate credit in property in APAC, but is it really a slam dunk trade? Time to get back. I think we need for the reopening stories to actually gather some legs first.
Jeffrey, thanks very much. Thanks for joining us. Jeffrey Yu of BNY Mellon joining us here on set in London. Coming up on the programme, we'll get back to the fallout from FTX. We'll be joined by Lex Sokolin, who is head economist at blockchain technology company Consensus. How much is he trying to draw a line between FTX and, well, all the others, all the rest? Let's talk about that next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with JM Smucker CEO Mark Smucker. That's at 3:30 p.m. in New York, 8:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. Now, crypto prices are falling as more details about the downfall of Sam Bankman-Fried's FTX empire come to light. New court papers show the company owes its 50 biggest unsecured creditors a total of $3.1 billion. Joining us now to talk more about this whole issue, the industry and the underlying asset, is Lex Sokolin. He's head economist, I should say, at Consensus. Lex, thanks so much for your time. I want to start with the idea that this is all very bad for Bitcoin or for cryptocurrencies, when it really seems to me to be an organizational problem. It's a problem with centralized finance more than it is the underlying assets. What do you think about the differentiation?
Yeah, absolutely. Thank you so much for having me. I think it's really important to draw this line between the economic activity and the entrepreneurship and the building that's happening on crypto rails that people talk about as Web3. And then on the other side, the financial industry that has formed around Web3, and in many ways is supportive of that. And it can start out as very symbiotic, but it can also turn parasitic and in that way damage the actual entrepreneurship and growth of the underlying technology, of the underlying economy. And so what we've seen as a large failure for about the last 9 months in FTX, in Voyager, in Celsius, in Three Arrows Capital, and then going back to Terra, is we've seen a failure of the financial services industry around crypto. And that looks like a liquidity crisis and a liquidation cascade. It looks the same way as Lehman Brothers in relation to housing, or long-term capital management in relation to fixed income. And of course, it's extremely damaging, but it is not reflective of the underlying economy that's being built in crypto.
I mean, the thing about Lehman Brothers and LTCM, they didn't shake investors' confidence in the dollar, right? Is this enough to shake investor confidence in Bitcoin when, ultimately there isn't much else aside from confidence holding that currency higher?
I think there's quite a bit of discussion we could have on the use cases and the fundamentals of blockchains, and in particular computational blockchains. But if you think about the housing crisis and the Lehman collapse, after that, people still bought houses and they lived in them because they need a place to actually live in. And in the internet boom and bust, after all of the financing and the venture investing and all of those companies went belly up in the early 2000s, it's not like the internet went away. We had more internet companies, more value created. And similarly, the crypto movement and crypto infrastructure, and in particular, the building of software on crypto infrastructure, it's a separate theme from how much we can get levered up in derivatives around crypto assets. So I think that the use cases remain. They're getting more adopted. There's more users on all of the chains. But at the same time, any financial crisis is going to be quite painful.
Okay. Good morning to you, Lex. I mean, maybe you see this as old finance, and therefore, you're not very interested in the views here. But Neil Kashkari, of the Fed, has a very different view on this. He was tweeting at the end of last week that this isn't the case of one fraudulent company in a serious industry. He says the entire notion of crypto is nonsense. It's not useful for payments, no inflation hedge, no scarcity, maybe debate that. No taxing authority, just a tool of speculation and greater fools. You still come up against that kind of view.
Yeah, it's unfortunate that we have these types of views still out there. I think if you engage with...
A lot of people think that. It's not just him.
I understand that it's very tempting to use a broad brush, especially for things that can be challenging, can have a different vernacular. But I think if we engage with the underlying data, if we look at how many millions of monthly active users there are on Ethereum, on Polygon, what are they doing? What are they opening up? What kind of applications they're using? What you're going to see is an analogy that's a lot more like an Apple application store with millions of users and hundreds of thousands of developers building stuff. And so I think it's very fair to react to the volatility in the asset class. But again, I think it's a bit of a lazy view on the whole thing.
Well, Lex, as you talk about users, let's also get specific about who exactly they are, because for so long, the narrative in crypto has been institutional buy-in is going to make a difference. It's going to be a stabilizing force kind of in the industry overall. But institutions are the very ones that are probably getting frightened by an episode like this, and really the episodes we have seen over the course of the last year. Where does that leave us if the institutional adoption starts to lag?
Yeah, I think this is a really complicated question with a lot of nuance. I think you want institutional ownership of the asset class in the same way that for equities, you might like to have institutional ownership and wrappers, whether it's exchange-traded funds or mutual funds, around the financial aspects of businesses. And in crypto, again, you want stable holdings from high-quality financial services companies, good packaging of those investments. But if you look at the actual, again, usage of applications in Web3, whether that's people coming together through decentralized autonomous organizations, DAOs, whether it's people purchasing NFTs to reflect culture, whether it's people using other on-chain contracts and software, end of the day, a lot of that is going to be driven by how does retail adopt this new internet. And I think it's, while it's easy, it is a bit of a mistake to just think the whole thing is about trading. I will also say that you've seen increased correlation between traditional risk-on markets, so whether it's equities or other risky investments, and crypto. And that definitely tells us that institutional hands are all over these asset classes, and so they do move together. But the underlying fundamentals of how people are adopting the asset class is very much, how does the software usage go up and down?
All right, Lex Sokolin of Consensus, thank you so much for joining us. Really appreciate it. And for more crypto conversation, make sure to tune into Bloomberg Crypto tomorrow and every Tuesday at 1 p.m. New York time, 6 p.m. in London. On this week's show, we will be speaking with the CEO of Circle, Jeremy Allaire. Anna.
And Kailey, happening right now, the UK Prime Minister Rishi Sunak is speaking at the Confederation of British Industry conference in Birmingham. He's trying to improve the relationship, perhaps, between the Conservative Party and business. Has been in trouble over recent years. And in the aftermath of the budget, the mini-budget we saw and all the turmoil that created, trying to improve relationships. The opposition Labour Party also in attendance. We'll continue to monitor for headlines, and you can watch the whole speech on Live Go on your Bloomberg terminal. This is Bloomberg.
But too often, those firms can't access the finance they need. That's why we're radically...
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Happy Monday, everybody. Let's take a quick look at what is coming up this week. On Tuesday, tomorrow, South African President Ramaphosa will be visiting the UK, the world's first head of state to be hosted for a state visit by His Majesty King Charles. Then on Wednesday, we'll be getting Fed Minutes at 2 p.m. Eastern Time. Provide some color on the Fed's meeting from November. U.S. markets will be closed on Thursday for the Thanksgiving holiday. Matt and I will be off eating turkey. Meanwhile, the EU energy ministers will be meeting to discuss the European energy crisis. And finally, we end the week with Black Friday. Discounts are expected to be higher this year to help drive purchases. And all the while, Anna, we will be slightly distracted by soccer or football, as you call it, with the World Cup.
Yes, I will be here through Thanksgiving. I'm just hoping that somebody in this office makes a pecan pie, and then it'll be worth coming to work. But yes, we will be distracted by the football, so it could be a shortened week in the United States and a week where we don't entirely concentrate on the markets here either. A lot of traders will be watching other screens. The 2022 World Cup has kicked off in Qatar. A lavish opening ceremony was followed by an opening match between the host and Ecuador. It's the culmination of a 12-year build-up that's been marred by controversy over the initial bid, human rights concerns, and the environmental impact. Bloomberg's Simone Volksman joins us now from Doha. The result wasn't the one that the hosts wanted last night, of course, Simone, but were they satisfied with how things had kicked off?
Yeah, I think so. I mean, the opening ceremony in particular was pretty stunning. There were lots of world leaders in attendance, particularly regional leaders. President Abdel Fattah al-Sisi of Egypt, President Erdogan of Turkey shaking hands for the first time, and also Crown Prince Mohammed bin Salman talking very closely with Gianni Infantino. But I think one of the things that's going to bring the controversy home yet again is a new decision by FIFA not to allow, or at least threaten, sporting sanctions against players if they wear rainbow armbands. These are the One Love armbands that were meant to be worn by captains of the English team, Danish team, 7 actually teams coming out and wanting to wear these. But FIFA's decision has encouraged these teams to tell their captains, no, you can't. However, this kind of adds fuel to the fire around all these controversies, right? In telling these captains they can't kind of demonstrate their free speech, demonstrate their support for LGBTQ rights, and obviously can't follow what the activists have told them, which is highlighting the controversial human rights issues in this country and around the world as a part of being players on the field.
Simone, thank you very much. Bloomberg Simone Volksman in Doha. England plays Wales later. Matt, I'm sure this won't have escaped your attention. You'll be glued to the screen, no doubt. That was sarcasm, by the way. But maybe for the England-USA game, that happens a little bit later on?
Yeah, no, I love watching...
Sorry, England-Iran, I should have said. That's what I meant to say.
That one I probably will give a miss. But if England plays the U.S., I'm very likely to watch that. And any of the big matches, I love to watch World Cup football. But I prefer to watch it, I think, from the television in my house rather than in a stadium built by people who maybe didn't want to build it in Qatar.
Yeah, there we go. Right, that's it for early edition. Surveillance is ahead. They'll be hearing from Carl Weinberg of High Frequency Economics, among others, commenting on the global economy. This is Bloomberg.